Hi, everybody. My name is Trevor Carlson. I'm the president of Heritage Reverse Mortgage. We specialize in reverse mortgages, of course, and as part of our goal and our vision to help to improve people's lives, occasionally I'll record these kind of videos that talk about the economy and market forecasts. And today, specifically, I'm going to talk about Recession 2023. Now, I'm recording this in April of 2022, so I might be jumping the gun, but as I'm about to show you, I don't believe I am. I want to give you this information because I think this is going to be very helpful for you in preparing for what's coming. Most people, when they hear the word recession, it's a little scary, right? The 2008 crash is still looming pretty heavily on their minds. But what I want to help you to understand is that recessions can be some of the greatest opportunities for people to get ahead financially if they prepare for it, if they're ready for it, if they act accordingly, and don't get caught off guard. And so I recorded a video almost 3 years ago exactly, and it was entitled Recession 2022, or excuse me, Recession 2020, Are You Ready? And that was in June of 2019. Now we know in hindsight, looking back, that there was a recession in 2020. The government did a very good job of pinning this on COVID, but the reality is that all of the flags were waving that there was going to be a recession in 2020. With or without COVID, we would have had a recession that year. And the reason I'm recording this video now and writing this article is because all of those same flags are waving once again. And in fact, they're waving a little bit harder now. Now I don't have a crystal ball. I started in mortgages in 2006, and so I lived through the Great Recession, survived the mortgage industry during the Great Recession, and I learned a ton from it. And so I'm getting pretty good at predicting recessions. And so hopefully this information is helpful to you. And so I want to share with you some graphs and some information that I think will kind of show and prove, the point that I'm making and where I believe we're going in our economy. And so this first graph I'm showing you, this is the comparison of the 10-year minus the 2-year Treasury yield. And the reason this is important is because the Treasury bonds are very good at predicting future economy. And so, to look at this, the best way to explain this is maybe to compare it with a CD. If you go to your bank and you're to buy a CD, you can buy a 6-month, a year, a 3-year, a 5-year, etc. The basic idea is that the longer term you buy for those bonds, you should expect to get higher returns, right? If you're going to give the bank your money for longer, they should be paying you more money for it, right? More interest. The same thing should hold true with the treasury bonds. And so the 10-year should be paying more than the 2-year. But what happens is that as we're nearing recessions, those two bonds get inverted. And so the 10-year and the 2-year get inverted to a point that you can see here on the chart. Those gray areas that you're looking at, those are the recession eras. And then right before every gray area, you'll see that the chart gets inverted. It gets abnormal. And without exception, this has happened on all of these recessions all the way back to 1980. And so we just last week crossed over that inversion line. And so we're officially in red territory. That being the case, I would predict the next recession will begin within the next 6 months. Within the next 12 months, it will be official. We will be in a recession. And that's just kind of how recessions work. Even though you can kind of feel it's happening, it doesn't become official until 2 full quarters have passed. And so that's why I say 12 months from now, it will be official. Everybody will know we're in a recession, right? This next chart, this is unemployment. And this again is an interesting chart because most people would think, hey, if unemployment is low, that means the economy is very strong. But I use the unemployment as a predictor of future recession. And the reason is because we are always, historically, since 1950, unemployment rates are always at their lowest at the beginning of a recession. They don't peak until after the recession or the end of the recession. And so you can see this has happened every single time. Low unemployment, recession, high unemployment. Low unemployment, recession, high unemployment. Time and time again, this has happened during every recession. So here we are again. You know, COVID is gone for the most part. Um, there are some looming effects, of course, but what you see is that our unemployment has gotten back to pre-2020 levels, which happens to be as low as it's been since the mid 1950s. Unemployment is as good as it's been in almost 70 years. And you can kind of feel this. If you've gone to a restaurant lately, you can see how short-staffed they are, how frustrating that can be to be waiting for service because, hey, people don't want those jobs because there's better jobs to be had out there. Now, this is soon to change. Next chart. This chart shows us our unemployment, or excuse me, our inflation rates. And again, this goes back to 2000 roughly, showing a massive spike in inflation right now. You could actually go all the way back to 1980, 1982, before the last time we've had inflation this high. And just by its nature, you just know that inflation causes recessions. When the price of goods skyrockets like it is right now, that leads people to spend less money because they have less money to spend. And that invariably leads to recession. And so, again, this is just a clear indicator of the fact that things are about to change. People are going to start spending a lot less money going forward. Housing. I wanted to address this because, again, most people are really nervous about recessions because of the housing crash of 2008. What they don't know is that historically, recessions are actually not a bad thing for housing. And the reason is because people will always need a place to live. And so if you track back to the 1960s, 8 of the last 9 recessions actually saw home value appreciation. Home values actually went up during a recession instead of going down. It was just the crash of 2008 that saw the home values fall like they did. But what's really happening there, what people don't understand, is that the recession didn't cause the housing crash. Unemployment did. People need a place to live. And so usually what happens when we go into a recession, people will tighten their belts, they'll start spending less money, but most people have to have a place to live, so they will continue to make their mortgage payment. But the recession of 2008 had such a jump in unemployment. So many people lost their jobs that they had no options. They had to stop making their mortgage payments. And that's what caused the foreclosures. That's what caused all of the market crash that we had. Now, so this next recession, that's the big question. If we can avoid massive unemployment during this next recession, it will be a positive thing for housing values, because recessions almost always bring lower interest rates, which spurs additional market selling in housing. And so again, if we don't have massive layoffs and unemployment, I would expect that we'll see additional growth in housing values over this next recession as well. Now, here's what I'm predicting. You're seeing all these pictures of toys. This is the problem in America right now, as I'm seeing it. Over the past 10 years, it has become a right for Americans to own lots and lots of toys. And so they have spent and charged and borrowed to the hilt to buy $200,000 boats, $150,000 sedans, $100,000 trucks, $200,000 RVs. You know what I mean? It is crazy how much money people are borrowing to buy toys. And so my prediction of the next recession is it won't be a housing crash, it'll be a toy crash. As people have to start tightening their belts to begin to survive from month to month, the first thing that will go will be entertainment and toys. They'll start selling off their razors, their motorbikes, their RVs, their boats, and many of those will actually be repossessed by the banks because of inability to pay. People will sacrifice their toys before they sacrifice their home. And as a result of that, we're going to see a massive discount for all of these things. And so if you're looking to buy one of these toys, you may want to be patient for a year or so, because it's about to go on sale and you're going to get a really good deal if you wait for it. Now, what will invariably happen is that as we do enter recession, the Fed will do what the Fed does, they'll lower interest rates. That will spur the economy. Hopefully that will boost the economy and get it going again soon enough that it does not hurt the housing industry. There's no guarantee there. It could last long enough to trickle into the housing market, but I'm personally leaning towards the idea, the prediction that most likely we will have a glut of toys on sale, but the housing industry itself will remain relatively stable throughout this next recession. Again, with the disclosure that unemployment does not get out of control. That's the one caveat that I would throw in there with that. So I hope this information is helpful to you. If you have any thoughts, even if you have feedback or you want to refute anything that I've said here, I'd love to hear it. I love to hear information that makes me better, makes me smarter, so that I can better serve my clients and our company and our staff in preparing for the future to help people live better. And so if you have any friends or family that have questions about the market, about reverse mortgages, about how they can live better in retirement with a reverse mortgage, that's what we're here for. Give us a call, shoot us an email, let us know how we can help you. Thanks for watching, and have a good one.